Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Hey, this is Lance with the Real Estate Risk Report. So today I have with me Jason Riley with Fairway Asset Management based in Austin, Texas. So, I met Jason is probably 4 or 5 years ago now. We were introduced, I think from some mutual acquaintance, but ostensibly they were, managing some investment funds and we're looking for someone to handle the fund administration for them. So they've been a longtime client. And I think the thing that makes Jason and his team, sort of maybe different than a lot of our other clients is that they're basically professional passive investors. So, they specialize in alternative investments, across asset classes, not just real estate, but, his job is to pour through all sorts of investment opportunities, alternative investments with some sort of private placement, and figure out how to build a portfolio, and in their case of assets that are generating real-time cash flow. So he has a specific objective how he builds his portfolio, but nonetheless, the secret sauce for them is Jason's ability to be, really good at underwriting and conducting and completing due diligence on these sorts of opportunities. So thanks for joining us today, Jason. I really appreciate your time. How are things down in Austin?
Well, thanks, Lance. I'm glad to be part of this. Things as it is with everywhere. It's an interesting time. We've of course dealing with everything with COVID, and I guess the one big difference is this summer you guys are the ones that are on fire, and not us down here in Texas. Usually it's reversed. Usually we're on fire in the summer.
Yeah, there's no doubt about it. Yeah, out west it's been pretty crazy few weeks with all the fires, especially getting this close to sort of the urban areas is pretty scary. But yeah, so why don't you tell us a little bit? Just give us a short sort of thumbnail sketch of your background and mainly just specifically around how you got into the alternative investment space, which of course when you got into it was not nearly as in vogue, I should say. It was, but it's quickly becoming that. The Yale endowment model, you're hearing about, how wonderful that model is, more and more and more. Whereas before they were kind of an outlier, but with all the alternative investments. So maybe just give us a little background on how you got into this.
Sure. Well, we've at Fairway, we've really been in the alternative space for the last decade. It just as necessity sort of drives invention or where you go. At the time back in 2010, we had a lot of clients who they had bond ladder portfolios that were maturing and they needed yield. They were people who were retirees, and they desperately needed that kind of monthly or quarterly income. And 2010 interest rates super low. Traditional bonds just weren't going to do it. And so we looked into the alternative space, and what we found some pretty compelling investments in a number of different areas that they generated a periodic cash flow, at a much more attractive rate than what traditional fixed was able to offer. They had great downside protection, and then the other real benefit was that it wasn't correlated to what was going on in the stock or bond markets. When you kind of think about that person who is in retirement back in 2010, this is someone who just lived through the '08 crisis. Saw the market, fall out from under them. And, so they were scared to death of the market, even though it was, it went on to, have an almost decade-long rally after that. And, they were just primed to say, give me an investment anywhere else. Help me find yield and let me invest somewhere else.
Yeah, I mean, that volatility is a killer. I mean, it's terrifying. I mean, it's being on a roller coaster every day. And so for you guys, I mean, with the kind of getting into it and obviously just these things aren't just right in front of you. So unearthing the opportunities is difficult as well, and especially if you're looking for yield. But when you do find an opportunity, maybe share a little bit with us about how you go about, like, what your process is. So, like, one might, I think, in the industry, they might call it sort of operational due diligence. You've got operational due diligence and investment due diligence. So maybe give us, kind of an overview of what your process is and how you, because I'm sure many people find you and your phone's ringing or they're knocking at your door, how you go about kind of filtering and vetting these deals.
Sure. Well, it's kind of interesting, Lance. We really sort of start at the end and work our way backwards. We really start by saying, what do we want out of this investment? And for us, as I kind of mentioned, it's got to throw off cash, at an attractive rate. So we get that periodic income coming in. It's got to have, good downside protection, and it's got to be able to be diversified. We believe that diversification is one of the best ways you can protect yourself. So we sort of start at the end when we look at an investment. We sort of look at the output first, and then we start working our way back to the beginning of it. And by that, in terms of how I look at something I want to invest in, I start looking at, what does the team look like? What is their process? How is it scalable and repeatable? Are they doing things that, are kind of one-off deals, and they're just doing a series of one-off deals, and that tends to, lead to problems? Or do they have a mechanism in place where they can just continually repeat what they're doing, successfully? I want to look at their team. I want to know, each. I don't necessarily care about the personalities. What I care mostly about is, do these people know what they're doing? Do they have experience? Do they work well together? And most importantly, I want to see where they've failed in the past. If you invest long enough, you're going to find that there's no way for you to not have a loss or not have an issue or not have a work through. I mean, that's just the nature of the beast. What is really, I guess, is telling about an investment manager's character is how did they navigate through that? If it's a real estate deal, how did they go about a foreclosure process? How long did that take? How well did they work with, with the tenant on the property? I want to see where they made a mistake and how they learned from that. Right. That's really, I think, the key when you're looking at the team.
Yeah, no, that makes a lot of sense. So for you, you kind of start with the team, and at that point you decide, you're like, hey, these guys have got, they walk with a bit of a limp. They've earned their stripes, so to speak. You feel like they're battle tested. At that point, then is it often sort of a pooled investment? You talked about the diversification. So I'm assuming that in most cases, there's some sort of diversified portfolio of assets that you're contemplating.
Right. The thing that scares me the most when I have a client that walks in and, say a new client to us, and he says, well, here's my portfolio of alternatives. And he's bought maybe interest in, say, like 3 property loans, and I say, well, okay, that's your total alternatives investment. And, it's good on you for going into the asset class. That's a good start in the right direction. What happens when one of those 3 loans goes bad, or the duration gets extended, or there's a problem? Now 1/3 of your overall portfolio is in trouble. And, so the way we think about it is, we say, look, we know that anything we invest in, there's going to be a certain amount of, like I mentioned, loss, certain amount of work through, certain amount of just issues, but the way you can protect yourself is by having access, by investing into a pool of assets. I like to say I would much rather own, 100 loans than just 10 loans. I'd much rather own 1,000 loans than 100 loans. A great real world example of how that works. We had a loan that we'd invested in a commercial property down in Houston. And when Hurricane Harvey rolled through, the property literally was underwater. The water came over the dams. There was 2 or 3 feet of standing water on this property. And the developer, he basically said, "Look, I'm turning back this thing back over to you as the investment manager. I'm done. I'm not going to make any money on this deal. I'm walking away." And the manager at the time, he said, "Look, okay, we're going to finish out this property and sell it off, and it'll be at a loss. But that's just kind of where it was because, again, the property was literally underwater." But that one loan, when it boiled up to the top of our portfolio, the loss was, a fraction of a percent. It was like 0.0001% of a loss to the overall portfolio, because it was just one loan out of hundreds that we had.
Yeah.
So, that's why, that's the way I think about it, right? I much rather have access to that pool.
Mm-hmm. So for you, I think you've mentioned in the past that, pre-COVID, you put a lot of stake sort of in the on-site visit, like actually going and meeting with the team. Maybe you could share a little bit about, what your thought process is going. I mean, I know in post-COVID it's more challenging, but I think it's interesting. I'd be interested to hear kind of what it is that you're looking to glean from that experience of actually going on-site.
The thing that I place a lot of weight on that on-site visit, and we always do multiple on-site visits, both before we invest and also after we invest. And of course that's been a little bit challenging with COVID. We've sort of had to alter how we do that, and of course Zoom meetings and whatnot have filled a lot of that void. But I hope to kind of get back to that more regular on-site soon. But what I'm really looking for is I'm looking for those red flags, right? First and foremost, the dummy check almost, right? I want to show up to their office and make sure it's a real office, right? It's not just a card table and a phone on some cinder blocks or something.
Yeah.
Which your listeners may find that kind of funny, but when due diligence has been done on groups in the past, I mean, they'll go to whatever is listed as the office, and I mean, it literally is it's a one room broom closet shut down, and not much going on. So I want to start looking for those red flags when I show up, right? When I show up, is the team organized? Are they all working together well? Are they able to, if I walk up to the guy who's, one of their accountants and I say, can you open the books on this one loan? Is he able to open it? No problem. He doesn't get nervous about it. He doesn't, start sweating, getting hot under the collar, right? They need to be open and transparent about everything, right? I also want to make sure that that whatever group we're investing with, that their focus is on the purpose we're investing in them. They're not, so if they're doing mortgage origination, for instance, or property loans, I want to make sure that's basically all they're doing in their shop. If I show up and I see that they're also running a investment advisory business, and oh, by the way, they're originating, film and finance deals, and they've just got about 4 or 5 different other things going on, then I start to question, how much time and energy are you really spending on the thing that I want to give you my money for? So, and then one last little red flag, and this was something I learned from the gentleman that kind of inducted me into the business and taught me. He said that when he did an on-site and was visiting a manager, the manager, took him to his office and he opened his drawer at his desk, and he had all these New York Yankees baseball cards, and he talked about how he'd been to every Yankees game that season, and my mentor there kind of sat there and started thinking about it, and he said, do you realize how many home games there are? If this guy is going to every Yankees ball game, how much time is he actually spending in the office and focusing on what we were paying him for? So just, red flags like that sometimes they lead you to a full stop, but often they just lead you to more questions.
Yeah, exactly. And that's just that stuff that's hard to, like you said, replicate from a distance. You need to be able to use all your senses. And, and obviously that's something that'd be challenging for, many sort of, truly passive investors, to do those things. But that's where I like to point that out, because I think that, my belief is that we're going to see more of what you and your team have been doing. And I'll obviously, in full disclosure, I'm a principal at Fairway America, not to be confused with Fairway Asset Management. But, I've always felt the same way about us, is that, that's the difference for us, is sort of being in the same position, is that, we might not necessarily be driving the project directly, but I mean, we do the same thing. We're going there. I mean, you earn your keep, because although it might be, you're not directing and executing the strategy it directly, there is value in having someone who's, again, building a portfolio. There's value in that, of course, and just being able to that kind of that level of diligence, that it's another level. And so I think there's a lot of value in that. The other thing I wanted to hit on too is that I think that you've got an interesting take on just leverage in general, and maybe you can just share a little bit about, how you view that, with the investments. I mean, how do you look at leverage and in a fund portfolio, or any of these assets?
I look at leverage. Let me start by saying I'm allergic to the use of leverage. There's some cases and some strategies where it makes sense, and I totally get that, and I wish those people well. For our own purposes, generally we are anti-leverage. The leverage is sort of like a double-edged sword, and it can cut you on the way down if you're not careful. What we've seen time and time again is those strategies that rely on a ton of leverage. When that leverage line gets pulled because of COVID, because of a 2008, because of a whatever you have it that causes the bank to pull that line from them, it really just it sucks all the oxygen out of the room, and it pulls the carpet out from under them. And here's why, really. If you think about someone who's, say, a real estate lender, and they're relying on 50% of their funding is from leverage. When that goes away, that significantly means that any new loan that they make, they have to fund it all from equity, and that's very difficult for them at that point, because they're already distributing cash out, they're already paying down on their existing leverage that they have, and so they effectively just they sort of just stall out. They're not originating new loans. They're having to pass on great deals usually, and it just makes the whole investment fall apart, is what we've seen. So, yeah. And that's kind of I guess the best case of a worst case. The worst case of a worst case is the bank calls it all immediately, and then the manager is basically in a fire sale. Yeah, and you never want to be in that fire sale situation, either as a manager or as an investor, because you're just not going to win out of that.
Yeah, and especially, at the portfolio level, it definitely, it's a yield enhancer. So, I think what I hear you saying is it's sort of like you feel like, you use it, but it changes the risk adjusted return equation, where it without the leverage, it was, you underwrite it to, it's an above average risk adjusted return. But once you start to put that leverage on there, it starts to tilt the other way, and it's not worth whatever extra juice you're getting. And then there's been studies that have proved, like they've done all the studies. It literally is to, manufacture yield. That's what it's doing. And but I like you brought up the other point too, of just the nature of it messes with their whole operation. Is if they just got addicted to the use of the leverage, their operation isn't generating enough new fresh equity. And I know for us, we had a portfolio in 2008. We made the decision and thought long and hard about it to take on a credit facility, and the reason I walk with a limp and Matt walks with a limp, and we earned our stripes, was because we made that decision. But yeah, we're similar. We've lived to tell the story, but definitely it's not worth the. It's not worth it. That's for sure. It's like, and not to mention, as the operators, you often, we always used to say and joke about it, but it felt real, is that we were entrepreneurs before we got into it, and we actually became bank employees. So it's like we worked for them, and as entrepreneurs, it wasn't an enjoyable time being beholden to the bank. So
the other thing I don't like about leverage, Lance, is that often the people who are using it excessively are doing it to mask kind of the lower real return that their strategy has. There's been so many times where, I again, as I mentioned, I sort of start at the end of an investment, and I look at the return first, and then I start working my way backwards, and you'll see somebody who's returning a 12 to 14%. And then, you start digging in, and you see how much leverage they're using. And then when you really boil it down to see what their actual gross return is without leverage, it's really more like a 6 or 7% return. And I don't get excited about that. I think you can get more into the teens type of returns without the use of leverage, and avoid all those headaches that we just talked about.
Yeah. So for you, I mean, in your career, I mean, what is you speak to like what you put your potential the managers you're going to invest in, but like what's your worst investment decision you ever made? Like what was the one thing you invested in that you just wish you could take back?
The where I think that we've gotten burned in the past has been when we've gotten into strategies with managers that accumulated way too much capital way too quickly. Success breeds success, obviously, and it's often hard for an investment manager to turn away that capital when it's knocking on his door.
Yeah.
And especially when you realize that a lot of these managers, they get paid a management fee as a percentage of
Mhm.
their overall assets that they're managing. So it's that 1 or 2% management fee on a $1 billion fund. I mean that
Yeah.
that'll pay a lot of salaries and buy a nice office, right? Without you having to do too much. So where I've seen us had issues is groups that we invested with that were small when we first started with them, or at least reasonably sized, and then they quickly grew to $1 billion, $2 billion, $3 billion sort of manager, and it just really when you get to that sort of size, there's all sorts of issues. The first is that when you're investing with someone who's that big, it's hard to move the needle in terms of returns. You think about $1 billion fund. If it makes $1 million in a month, that's percentage wise, that's really not that's really not as interesting.
Yeah.
As say $100 million fund that makes $1 million in a month, right? It gets difficult for those large players to buy into deals or invest into deals to move the needle. And so consequently, they start doing bigger and bigger deals so they can get something that will move the needle. And so now you've got the problem with, okay, maybe I invested with, say, a real estate lender who specialized in deals that were, $500,000 to $1 million. Now this guy's buying deals that are, $10 million to $50 million just so he can make it register. Well, now the whole tenor of this investment has changed, right? The whole focus and strategy has changed.
Yeah, which then changes that. I mean, so when you guys look at those sorts of things, like how much does lockup, like the lockup period, the time that before you can redeem, do you think about that a lot? Like someone's got some 3 or 4 year lockup, you're like, you want, or does that, how do you view the lockup?
Well, the lockup is, that's an interesting question because, the lockup is sort of a, it's something that can hurt you, but it's also something that can protect you, right? It can hurt you if you have a really excessive long lockup and you start to fall out of love with the manager you're investing with. And you realize, I'd like to get my money out. I'm not liking some of the things I'm seeing. I'm starting to see some red flags, but I'm still stuck in here due to the terms of the lockup. So it can hurt you that way. But where it can help you is, it can really make sure that that there's not a run on the bank scenario and that there's not a mismatch with the asset that's being invested in. If the manager if he's doing, say, real estate bridge lending, and his loans are 1 year in duration, it doesn't make a lot of sense for him to have only a 6-month lockup. And I'm kind of making these terms up, but just to illustrate.
Yeah.
Because at that point, let's say half the investors decide they want to redeem their money out. Well, you still got another 6 months past that lockup before the rest of that money pays out for that asset pays out. So you end up with an asset and liability mismatch is kind of the way we think about it.
Yeah.
So I guess for me, what I like to see a little bit of a lockup in there and make sure that it pairs up with the assets. I don't want to see an extremely long lockup that is, to me, that's a red flag. To me, that's the manager saying, I'm going to make sure I keep everyone in here, for my benefit rather than for the investor's benefit.
Yeah. Do you guys do any investing into closed-ended funds, or is it all? Do you always have a redemption rate?
We do. We do a mix of open-ended and closed-ended vehicles that we invest into. In my perfect world, everything would be open-ended, but the reality is that often an open-ended structure doesn't make sense for everything. And often just functionally, it can be structurally easier to do a closed-ended vehicle. In some cases, if you say you're building a portfolio of real estate loans, you might want to say, okay, we're going to put the year 2020 vintage loans all into one closed-ended vehicle, and then they'll run their course naturally and pay off, and they'll all exit and liquidate, and then the vehicle will naturally wind up and dissolve once that's over with. That some people like that because they can kind of isolate their risks. They can say, I don't feel like this is a good year for this sort of vehicle, so I'll stay out of it. Or I think it's a really good year and I want to limit my risk in case I change my mind next year. It also just it lets you have a finality sometimes where open-ended vehicles don't, and where open-ended vehicles can sometimes get into trouble. So I like both. They have their merits, and I think if you're an investor, you have to just decide, what is the best structure for you.
Yep, got it. So what is sort of another thing that maybe we haven't touched on, just that in the diligence process, that's sort of the something that's a box that you just got to make sure is checked?
I love doing reference checks. I always ask to speak to a number of current investors and a number of former investors. And I also want to speak to investors who've gotten cash out. And here's why. Current investors, it's good to talk to them you can pick up on their experience, how it's been with the manager. Has there been good communication flow? Has there been, have they delivered everything they've said they would? What's their experience been like? I like to talk to the investors who've gotten out. I want to find out why they left. Was it because you fell out of love with the manager? Was it you had something else going on? And then what was your experience like cashing out of that vehicle, of that investment vehicle? Was it smooth? Did it take a long time? Did you get yanked around a lot? Did it seem to take forever? Or not up to your expectations? And then also, you end up, kind of like I mentioned earlier, you end up with threads that you end up pulling on. I don't know how many times I've done those reference checks, and I'll be talking with a guy, and he'll say, I've liked this manager, but that was an interesting lawsuit that they faced. Oh, well, okay, tell me more about this lawsuit. Because I didn't come across any of that when I was doing our background search. Or they'll, the other question I like to ask is I'll usually ask it last, and I'll say, hey, is there anybody else you think we ought to talk to in our diligence process? And there's been, I don't know how many times I've had them say, well, you really ought to go talk to this guy because he's got an interesting story. And that, again, it kind of leads to more threads. And, if the threads end up unraveling the sweater, then that's a good thing to learn in the diligence process instead of after.
Yeah. Is there anyone that you guys have ever taken a look at and done some diligence on that you turned down that later turned out to be running some Ponzi scheme or some kind of fraud, or or had some sort of issue that you kind of sniffed out or figured, or you had a bad feeling about, or any interesting stories in that along those lines?
Yeah, there's a couple. There's one case where we were invested for a number of years, and then we started seeing red flags, things we didn't like, and got out before the bottom fell out of it. And then there's another investment where we started the diligence, but things weren't adding up as we sort of looked at their assets. And in the first case, we did a lot of investment in peer-to-peer loans, which are loans originated generally on the online platforms like Lending Club and Prosper. Mm-hmm. And we did all that work back in, I want to say 2012, 2013, when all of that was fairly new to the market. And we had a great experience with it when we first did it. We had some pretty nice returns, in the teens. And as we did those loans more and more, we started to see again suspicious kind of red flag behavior. We started to see we would see credits that would go ahead and go into default, and we wouldn't see a whole lot of action in terms of recovering them. And then we would also see high interest rate credits that were paying well, high interest rate loans that were paying well, and then they would get to a certain point, a couple months in, and then they would refi out. So, we just started seeing a lot of weird activity that didn't make sense to us, and we ended up wrapping up that investment. And if you go look at kind of the returns in those products now, a lot of managers in that space are in the low single digits. At least the ones that are still standing. A lot of managers in that space just folded up shop and left it.
Yeah. Wow. Yeah. That's nuts.
Yeah.
I mean, that was one too, that it did seem like in the beginning, it seemed very intriguing and interesting. And then it just started to feel like, there's all sorts of weird stuff going on. And like you said, I mean, it kind of goes back to, I think what you were talking about is that once it's that ability to grow and scale, or, once it's the more momentum that has, all of a sudden everyone starts to stretch. There's just, and which of course that's the misalignment, right? Like you said, is that there's usually some sort of asset management fee or fund management fee or some, that's how they get paid. And so it's an inherent misalignment between and obviously it's like you need to make money so that you can, run the operation. But at the same time, it's the law of large numbers. We all are aware of it, and they're after it, but finding good investments, right? Which is what I think you guys experience, is that it's easier said than done to go find high quality, higher yielding, cash flowing and investments. Like that's a lot of work. There's not a bunch of them out there.
Well, and kind of going back to the sizing issue, one of the things that I've mentioned the term red flags a lot. One of the things that's a green flag for me, a good sign is, when a manager will tell us, hey, look, my fund or my vehicle is, say, 200 million, but I'm going to cap it at, say, 400 million, because I really think that's the optimal size for us. And I think if I get beyond that, then I'm going to get into all those problems we mentioned with the guys that get too large. I love to see guys who have that discipline. I even love to see guys who, start to bump up against that kind of their own internal limit and start sending cash back. That's got to be, as someone who runs investment vehicles myself, having the discipline to be able to send that cash back to investors when they're not asking for it can sometimes be that's a tough thing to do. But it's a great sign of maturity and sophistication out of any manager you're with, that they know what their limits are for their strategy, and they're more than willing to push that cash back to the investor rather than just sit on it and either not deploy it or deploy it unwisely.
Yeah, no, that's great. Well, this is really, really, really good stuff, Jason. I appreciated our time, and I thank you so much for joining me today.
Yeah, well, thanks, Lance. It was a pleasure. Anytime.
All right, man. Take care.